Sure, please. Let's see. Yes, we are recording. So welcome everybody again to this virtual presentation. We are delighted to have with us Alessio. He is hailing all the way from Birmingham, Alabama this morning. The beauty of having virtual events is that we can tap into resources around our country. Again, this topic was something that came up in our board meeting a few months ago. It is our role here at the Chamber to have our finger on the pulse of our community, whether that is in our business community, whether that's here locally, nationally, and essentially globally. So we are delighted to bring this here with you today. This is going to be an interactive conversation. So please, if you have questions during the presentation, we are not going to kill you with death by PowerPoint. We are just going to hear what the professional has to say. So I want to give a proper introduction. So if you guys will bear with me just one moment while I read this bio for you. He spent his early career in learning life in insurance products with Protective Life, followed several years of forecasting and profitability management at SunTrust Bank. He did that through Y2K. So he's got a little bit of a history here on issues that arise quickly. And 27, he went to Compass Bank, an institution across the southeastern United States, providing interest rate risk management consulting, managing credit risk through the financial crisis, and navigating regulatory changes post Dodd-Frank. I'm sure he'll allude to that. In 2010, he moved his attention to fixed income markets with responsibility for sales and trading and expanding distributions at BBVA, debt capital market origination. In 2014, he joined Cadence Bank as the treasurer, putting his career and skills to use, developing a top-class performing treasury team. What Alessio is most proud of is the relationship he has cultivated over the years and continued connectivity to those interpersonal resources. Without any more further ado, Mr. Tell, I'm going to let you take the floor.
Hope, thank you very much. Appreciate everyone, and I'm glad to be here with you today. That write-up, I have to thank Sheena Cochran and Danielle Cornell. They wrote that for me. I think the first time we did one of these Zoom economic forums as a bank was April of 2020. We had it scheduled just before COVID started, and then as COVID hit, it became more and more kind of frequent for us to do these things. So thank you very much for that introduction. I appreciate it. I also want to thank Justin for setting this up. He and Andy kind of reached out, and I'm glad that they did. We were in the middle of an acquisition here, a merger. A merger actually closed in October of 2021, but Bancorp South and Cadence Bank are merging, and our Cadence team, legacy Cadence team, with Teresa Stinson on this C&I side with Leslie Fredericks, and then our business banking side with Lester Santos and Patty Robinson down there in Tampa, have now joined forces with Justin and his team to kind of be able to deliver as a combined bank, which we will be Cadence Bank moving forward. I want to thank everyone there for such a great job that they do in your community, helping our clients achieve their goals. So I really appreciate everyone down there. I'm going to start with a disclosure. My comments and views and opinions expressed today, especially since we're recording, I'm going to go on record, are solely my own, and they do not express the comments and views and opinions of my employer. So you're going to get my perspective, not necessarily our institution's perspective. And that perspective really comes from my background as a practitioner. I'm not an economist. I actually have a bachelor's degree in mathematics. And in my position as treasurer of a $47 billion bank, I'm a recipient of an awful lot of information from banks, economists, broker-dealers that kind of help us get a sense of what's going on within our financial markets and our economy. And then how do we direct the bank, which is kind of what my role is now, to make sure we're taking advantage and really risk managing out of some of those situations. And so whether it's our $15 billion investment portfolio that we run, or managing liquidity of the bank and the different wholesale sources that are available to financial institutions, and then kind of interpreting what's going on with interest rates and market risks to be able to kind of hedge and protect the institution as things change. And so with the title we have today, These Uncertain Times, which I did not come up with, but I'm happy to talk through. I kind of wanted to start there because Hope and I were talking earlier as we got on. She's in the middle of an economics class, and a lot of times the science of economics is challenged by what we actually experience. And we're experiencing things today that are very different from the science of economics. And it's important for us to understand that. And I'll start with COVID because it's probably the single largest catalyst for what's happened over the past 2 years. And it's so different than the experience of our generations. We have had, unfortunately, half a billion people have been infected across the world. We've had 6.4 million people die from COVID. In the US, that's 1 million people alone. Europe, it's almost twice that much. And what's important to take away from that is that that's an experience. You've probably heard a lot of things about demographics and how this is maybe not all that significant from a demographic perspective. In other words, it's not like more people are dying than would normally die in a normal year because of all the other things that we've done to protect people. But the problem is that it has an emotional impact, and it has a very specific, obvious economic impact. And when COVID started and we started looking at what were going to be the results of our behaviors, I use the term an accelerant. COVID was an accelerant to a lot of cultural adoption. And this Teams meeting, where we were talking earlier about Zoom and about Google Meet, those tools, while we're being adopted early on, that accelerated the adoption of those things. And there were other obvious effects, buying habits, online shopping. It was obviously there and growing, but the acceleration of adoption there was amazing. A lot of times you'll kind of think of older generations having sometimes a difficult time adopting newer technologies. Well, all of that was sped up as well. And we had big changes in savings rates. Now, some of that was stimulus related, and we'll talk about that in a second, but people in general weren't out spending. And so they had a lot of more discretionary income, and they just didn't have anything to do with it. And then you have things that are still working through the pipeline. And I'll talk about some of the commercial real estate issues that are going to materialize as we go further through this experience. But that volatility is ongoing. COVID is still here. We've got variants that are going to continue to come through. There are ebbs and flows to those. We're learning and getting better at dealing with them and treating people. And hopefully the impacts long term will still moderate, and we could find ourselves in a little more stable situation as we go forward. But those things are definitely, COVID is the most significant issue of this uncertain time. And a result of that COVID is really the unprecedented fiscal stimulus. When we came through the Great Recession in 2008, the Federal Reserve developed an enormous toolkit of things that were put on the shelf that they could pull off to help provide capital and stability in certain environments. They obviously leveraged their balance sheet more than they had ever leveraged it, and we'll talk a little bit about that. But they also created programs like the PPP and the municipal funding lines and the primary money market lines to all provide stability to capital markets in these types of events. And when COVID hit, the Fed took all those tools off the shelf and opened them up. If you get a chance, we kind of forget how many stimulus packages there were from Congress. We kind of forget all the tools that were brought to bear on this. If you go to Investopedia and you look at the COVID response, I looked through that the other day, and it's just amazing to me. We'd spent somewhere about $5 to $7 trillion from Congress in bringing the economy through this and pulling people through this in a way to prevent massive disruption to their lives. I mean, it was already a lot of disruption, but to keep people safe and to keep people solvent and fed, we did a lot. Even executive orders, Trump initially, and then Biden reissued them for rent moratoriums and student loan deferrals. The amount of debt suspension has been pretty amazing for both the consumer and the corporate sector. And that's still we're starting to see some of that kind of pull through. Unfortunately, we've got a lot of people who are behind in their rent payments. And when they catch up and if they catch up is kind of a question, both on the corporate side as well as the consumer side. And so we're going to see that start to materialize as we go through this. But that unprecedented fiscal stimulus really was unbelievable. Now, it did add to government debt. And one of the things when people always ask me, what's the most common question that I get when I do these presentations? And it usually has to do with how bad the government debt is. I would say that government debt is not bad, but it has increased pretty significantly here in this cycle. We had just about we have about 30.5 trillion in government debt. That's up 20% in the past 2 years. And it's not getting any better because we still have government deficits, right? So in 2019, our government deficit was, this is pre-COVID, was $1 trillion a year. Year to date, today, we're not as bad off, but we're 136 billion still in government deficits. And those are just adding to that government debt burden. And while the government debt in and of itself is not bad, especially when it's this cheap and has been for the past couple of years, it can become an issue because it slows down how much velocity of money moves. And let me explain a little bit about what that means. When you think about money supply, so how many dollars are in circulation, it's dramatically increased because the Fed has increased its balance sheet. So the money supply in 2016 was $12 trillion. In 2022, it's just under $22 trillion. So we've had almost 100% increase in 6 years in the total money supply. And that wouldn't necessarily in and of itself be a problem, except that it's come at the expense, it's created by debt. And that debt to GDP issue is really how much of a burden is that debt cost, the cost to service that debt, dragging resources that could be deployed for investment. So instead, GDP is paying down debt more than it has been in the past. And the Fed is partly to blame for this because they've created a balance sheet that's basically 37% of GDP now. It really was in 2008, the Fed typically ran about a 6% of GDP balance sheet. In 2015 to 2000, it kind of hit a peak of 26%. And then in 2019, it fell back down to 17%. So that tapering that they were doing in their balance sheet was starting to have some benefit, plus GDP was growing. So that ratio is improving. But today it's 37%. So we're back up way above even the high point. And as that debt basically is a drag on real growth that can be created from the reinvestment and the speed at which we can transfer money between different economic activities. And so as rates rise and those debt costs become higher, if we don't reduce the amount of debt, it's going to slow velocity of money further, and it's going to create more of a dampening effect on real growth. The Fed has kind of discounted this, and you can kind of hear this from a lot of economists, that there are plenty of countries out there with worse ratios of debt to GDP, and that's very true. Even in the developed markets, we are not as bad off as others. But what used to be a very strong competitive advantage, we're gravitating more towards the median and becoming less competitive because our debt burdens are so much higher. And that is really the balancing act, I think, when you think through how does the U.S. position itself going forward to continue to be a leading economy. And we're losing we're losing our competitive tools in that context. I'm going to reiterate, if you have a question, please type it in the chat box. We'll be happy to answer it as we go through this. I can, as anybody who knows me for a while, I can probably talk for a long time, but I'd really rather hear from you and address your concerns and issues. So if I say something that triggers a question, please don't hesitate to type it into the chat, and I'll be happy to answer that. Other things that are going on is that the dollar is extraordinarily strong. We are up to an all-time high for the dollar index. That's up 10% from this time last year. And there's some really significant price implications to that. You know, everybody talks about how much gas has gone up and oil has gone up. Well, the reality is if the dollar was kind of more in its traditional value position within the developed markets, we'd really be sitting at a 10% higher gas price. And so there are some of those things to think about because those commodities are denominated in dollars. That dollar strength has an impact on the pricing, it also has an impact on the trade balance and kind of the competitiveness of U.S. goods in other markets. And so that's part of the challenge we've got with dollar strength. So we do have a question. What are some things in the U.S. can do to change its trajectory from becoming less competitive? That is a great question. And no one likes to hear austerity, but the reality is if you have a little bit more discipline about budgeting, if you take time to make the investments in one of our biggest competitive advantages is our secondary education, our higher education system in the U.S. I mean, the globe comes here to learn. Retaining that talent, keeping an innovative approach, and allowing free markets is part of the things that allow us to be competitive. There are things that we're doing. Gasoline's a great example. The U.S. is amazingly blessed. Essentially, we can be energy independent if we wanted to be right now. We basically produce as much oil and gas as we consume. We have an amazing breadbasket in the U.S. that's actually contiguous with waterways that help us move and efficiently move that capital and goods better than anywhere else in the world, quite frankly. And so we have a lot of those kind of natural advantages, and allowing capital to accurately and efficiently find the best and highest return is really the best way to keep that competitive advantage. We've spent a lot of time over the past 40 years outsourcing to cheaper labor costs and cheaper production. Some of that's changing. We'll talk a little bit about that a little later too, about what those implications are. But we're basically bringing this deglobalization that's occurring because of COVID. I mean, Ukraine's a perfect example where Russia's moved in, and that disruption of that food source and really the oil and gas from Russia to Europe, all those things are going to create an environment where countries are going to need to be more self-reliant, and that's going to reduce globalization, which is going to cause prices to be higher. And just recognizing that and embracing it, as opposed to trying to find ineffectual or inefficient capital flows, is really how you maintain that competitive advantage. There's also, in the dollar strength issue, there's a lot of liquidity concerns. When the dollar's strong, and most emerging market debt is dollar denominated, they need dollars to pay off their debt, right? When debt comes due, they have to actually go get cash, US dollar cash, and pay down that debt. Well, the reason the dollar is so strong is because there is so much demand for it, and our rates are forecasted to be higher than the rest of the world. And so there's an advantage to investing in it. And as more and more dollars are demanded and the price goes up and that strength maintains itself, you're going to see issues around liquidity. And the Fed thinks that they can manage this. They've done a lot, actually. This is something that most people don't really hear about very often, but there's a lot of dollar swap activity between the different central banks, and they're trying to manage that effectively. And one of the ways that they support those operations is really through their repo and reverse repo programs that they have. And the Fed did something pretty unique a year ago that probably missed the radar of most people. It's what they did actually in 2008 to the Fed fund market. Banks used to trade money overnight to one another before the crisis. Well, when the credit crisis happened and the recession in 2008, the Fed came in and basically took over the Fed fund market. They said, "Come get all your money from us, and we're going to be the cheapest provider." And so all the Fed fund dealers out there kind of folded up shop and said, "Never mind, we're done." Well, last year, the Fed basically did the same thing with the repo market. They came in and said, "Hey, we're going to be the lowest rate for investing and the highest rate for borrowing." And so they basically capped the repo market. And they're moving all these repo flows into their balance sheet to kind of help them manage liquidity. Because as they roll their balance sheet down, they fund that balance sheet with deposit reserves from the banks. And that reserve base, they're hoping to get deployed into loans through banks and won't be there to fund their balance sheet. So they're really trying to orchestrate quite an amazing liquidity transition from a deposit reserve basis to a repo basis so they can support the balance sheet that they have. I think they still want it to shrink, but I think their long-term intention is to remain in that market and to hold that market. I call it hostage, but they wouldn't like that term. But they do. They basically own that market now, and that's something that's fundamentally changed from the way that parties used to get. I mean, you could still find repo in certain products, But the lion's share of that, when you're talking about a $8 trillion entity that's trading repo, they can basically own that market. So if we have more money and we have a stronger dollar, we have slower velocity, we've got more income. I don't know if you checked on well, we have had, and I'm going to talk about CPI here in a second, but when you talk about how wages have increased, not only have overall wages increased, but the amount of wages related to government transfers has significantly changed. Prior to COVID, the amount of income in this country that was from government transfer, so that's unemployment, that's subsidies, that's food subsidies, that was about 18% of all income in the US was derived from government transfer. Now during COVID, that blew out to 34%. And what's happened is it's settled back down now at about 25%. So 25% of all the income in the US comes from government transfer. And in general, that is actually targeted towards the lower income classes, which means that they have more income than they had pre-COVID. So that's a recipe for higher prices. Although they may not be the largest wage earners, having more money provides them with an opportunity to pay more for goods and services. So though we've got some fundamental changes in this reversal of globalization, and that's a long-term trend that's going to create support for higher prices for a much longer period of time. We had, over the past 40 years, a lot of productivity enhancements that really brought prices down as well. I think that productivity enhancement opportunity is still there, but probably not as strong as we've seen over the past 40 years, especially because I'm not 100% sure that even as corporate economy is as productive as it would have been pre-COVID. And I'll explain a little bit about that. Some of that's good and bad, but I think that when you have people working from home, some people are very much more productive, but not everybody is as productive in that environment. There's a reason why we got together over the past 100 years to work together. And I think that doesn't just solve itself instantly. So I think that there is a recipe here for higher inflation going forward. Maybe not higher than it is today, but definitely higher than what we've seen for the past 5, 10, 15, 20 years. And so what do we have today? We have a CPI number yesterday that was, it was a rocket number. It was 9.1% year over year. It was crazy high. Energy, month over month, energy prices were up 7.5% month over month. Gasoline alone, month over month, 11% increase. And food, while it doesn't sound as big, 1% increase month over month. That's a 12% annualized increase in food costs. Now, while those aren't core pieces, right? They're not core inflation. They are indicative of what people have to spend and really get to what the discretionary number is, right? What do people have as discretionary income that they can spend on goods and services? And that really is what we're trying to figure out now is how is that going to look for the next couple of quarters? Are we truly losing, number one, discretionary income, and number two, really more meaningfully, are we losing our purchasing power? So if CPI is 9.1, and then you look at wage growth and that's only like 3%, that would tell you that overall we're losing purchasing power. I think that the devil's in the details on the wage number, specifically that we are seeing a lot of folks exit the workforce. And usually those are the older retirees who are making more money. And so that is a real drag to wage increases. And what we're seeing on the lower economic spectrum is wage increases that are much higher, I believe, on a percentage basis than that 3 to 4%. And if that's the case, then we could see an environment here where wages and purchasing power are actually increasing for the lower economic spectrum, and therefore feeding more inflation for a longer period of time. And that, to me, is one of the biggest, I think, things to look at to see, are we really losing purchasing power or not? Energy can be very volatile and it can go up 10% this month. It could go down 10% next month. I wouldn't expect that. There's a lot of fundamental things going on in the energy space, and one of those is obviously the US's willingness to provide a free market for developing those resources. It's just not like it used to be. And so there are some extra costs and barriers to entry that are causing that to happen. And then, of course, you have the global issues around Ukraine and Russia and what's going on with their disruptions. So how does all this affect the consumer? So the consumer right now is really pretty strong. On average, there's a lot of devil in the details about what happened with COVID when it comes to different socioeconomic classes and different segments of our population. And the Fed really had a real foot on the gas pedal for the past 10 years, trying to not just get to full employment, but get to full employment for all. And it's really difficult to do that at the Fed. And they did their best, but I think if you look at the numbers, especially like the 18 to 25-year-olds, especially if you look at some minority segments of the population, really kind of got left behind in that whole spectrum. And the only way to really solve that is for Congress to do something on a policy basis that will provide a change in that. But the Fed did the best they could. And in that process, though, if you look at the average population, they've got a good savings cushion. Those that actually had assets have higher prices. We've all seen, and we're looking at a 600 down on the Dow today, but in general, we've seen equity prices up. We've seen housing prices up. And so in general, people have higher asset prices and more wealth than they had pre-COVID. And then they've all got access to credit. Consumer credit declined through the crisis pretty handedly as people paid things off. In April, we did start to see a reversal in those revolving lines of credit for consumers. They started going back up. So maybe that's a bellwether for the consumer falling a little bit more behind. And we clearly see that savings rates have fallen back down below pre-COVID levels. In January, pre-COVID, the savings rate was 5%. Versus the savings rate pre-COVID was 8%. In January of this year, it's 5%. During COVID, it bumped up to almost 12%. But in general, it's come way back down and actually below historical levels. And when we look at the revolving lines of credit, one of the things we need to be concerned about that is interest costs are rising. I think when we started seeing the expectation for interest rates to rise at the bank, we had been at low rates for so long. Even the little uptick in rates we had in 2016 to 18 really didn't sink in because it was only a couple hundred basis points, and we came back down so quickly. It was difficult for people to get the concept of what does this rate increase mean and how fast it's going to occur. I think what resonated with people is that when this thing started, the prime index was at 325. Well, when you went to somebody and said, hey, it's going to be 650 by the middle of this year, they were sticker shock. And that's really what's materializing, is that by the end of this year, we're probably going to be at a 650 to 675 prime rate. And we hadn't seen that in a while. I mean, it's been a long time. So, and that's going to affect consumer because most of their debt is tied to that, especially the revolving lines are tied to that prime rate. See the same thing in the mortgage rates today. If you look at mortgage rates, in January, 30-year mortgage was 327. Yesterday, it was 569. And in mid-June, it topped out at 6%. So the cost of home ownership for someone to get into a new home has gone up 40% since January. I want you to think about that. And in the banking business, we kind of lean towards a debt to income ratio of max 35%, really like it to be 25%. And if you just take that cost to service a mortgage, the insurance and taxes, because prices are up so high, it's a 40% more dollars today to buy a house than it was 6 months ago. And that's just starting to materialize, right? I mean, we're seeing mortgage pipelines fall back pretty precipitously because all the refi opportunities disappeared. The good news is that the inventory is not all that great. In other words, there's very little inventory. So typically, you would have prices fall if there was less demand. But in this environment, I think we're going to have a little bit more price stability because housing is so scarce that it will be slower to depreciate than especially what we saw in 2008, where inventories were amazingly high. But getting into your first home is going to be harder and harder. And I think you'll start to see more political commentary about that as well. Justin has a question. Hot topic today is a run-up in real estate prices with no end in sight. It is different from 2006. Is it different than 2006? Will higher rates level it off? So yes, it will level it off, Justin. Kind of like I said just now, I don't think it'll fall like 2008 and 2006. I think we will see a softening, but certainly not a reversal of this 20% increase that we've seen over the past year. And I think it's going to be sector specific. So if you look at commercial real estate, you've got sectors that are going to fare very well, and then you have other sectors that are going to be really flatlined for a long time. Office space, I think you're going to find that flatlined for a long time. If you look at kind of warehouse and wholesale, that's going to still rally and be strong, good for demand. It's kind of how the from the retail to the wholesale change in how we're receiving goods is kind of going to drive the need for that square footage in the wholesale space, warehouse space. I think that manufacturing is going to also do very well. Industrial will do very well because we are still bringing back a lot of the production over the next, and this is a long-term trend. This isn't going to happen overnight, but it's going to happen over the next 10 to 15 years as is supporting those asset prices as we bring and put more of this real estate back into productive value. The other thing to keep an eye on in the inflation as it relates to home ownership or housing in general is the owner equivalent rents. A component of CPI is what does it take for someone to make their rental payment? And it's a very slow moving number. They lag it pretty significantly because they don't want to handle these kind of wild swings in it. And it was up 5.5% year over year. And it was up 0.7% month over month, which is actually an annualized rate of 8.5%. And it's accelerating. So what we're seeing is what we've seen in house price appreciation is now starting to flow through this owner equivalent rents, which is going to give some tailwind for inflation to be higher for a while as its component of that. I'm trying to think if there's anything else on the home ownership side or housing I'm happy to discuss. There's the Fed and the Congress has put a lot of programs in place that make the U.S. much more resilient when it comes to home affordability than the rest of the world. And I'll talk about that in just a second. We do have a question that came in. What steps can consumers and businesses take now to protect them from the pending recession? So I would almost tell you that the recession is probably already here. We had technically, we had negative GDP in the first quarter. We're now looking at potentially having negative GDP in the second quarter, according to the Fed's estimate, Fed Atlanta, I should say. And if we are in a technical recession, I think the severity of it is really going to play in. We're so used to a recession being the worst of worst because we went through the Great Recession, right? It's the last one we had, that we really don't, I think we're going to have a tough time understanding how do we deal with a recession that is mild when employment is so strong and wages are increasing. And so it may not be that we have to kind of change entire tax to really batten down the hatches for a recession. It may be that we just have to ride through it. And I've got some good thoughts at the back end of this, kind of talking about how protecting yourself in this environment as it relates to prices and interest rates. And I'm happy to talk through those things. I would say the first thing that I would recommend you do, if your business has any debt that is floating rate, you need to think really long and hard about fixing that debt. I know that rates are higher today than they were a month ago, but the risk is that they could be really high 3 months from now. And the curve is actually technically it's inverted. So if you look at the 10-year rate today, it's 3%. The 2-year treasury rate is 3.24. So that 10s to 2s, you may have heard from an economic perspective, is kind of an indicator that recession's coming when it inverts. It's basically saying that short-term rates are going to come up, and then long-term, those rates are going to come back down lower. And so I would tell you to take a strong look at locking in your debt costs if you've got that. Also, there's some changes at the SBA. I don't know how many of your members may have SBA loans. When they go to find a new SBA in the 7A program, those the maximum spread that originators charge has been allowed to widen out. So on the smallest loan, it used to be prime plus 3, and now it's going to be prime plus 6.5. So not only is the prime rate going to be higher, which is your floating index, but your spread is going to be wider. So your debt costs are really going to rise from an SBA perspective. And so I would tell you to find, if it's not too late, find a strong traditional bank that might give you access to capital outside of the SBA lending programs. There's some real advantages to those SBA lending programs, don't get me wrong, but the change in this spread is going to have some implications within the market, not just from how the access to that capital is going to be more expensive, but also the investor who's going to buy that loan in the secondary market, that liquidity might get less available and might make those loans, even less attractive. So find a strong traditional bank, build a relationship, get them to understand your business so that you have somebody there to support you as you need to grow and as you need to find other access to liquidity. And then I would also recommend, if you have any foreign currency exposure, the dollar is so strong that you really need to find a way to hedge that foreign exchange risk. A lot of banks have tools to do that. We do at Cadence Bank. I would recommend you find an opportunity to hedge that risk, to kind of take that off the table, because things will become more and more disruptive. Bank of Canada yesterday increased rates 100 basis points. We're going to increase rates 100 basis points at the end of July. On July 28th, the Fed's going to raise 100 basis points now. Those things have implications that you may not even realize to the cost of goods that you're going to come in, and hedging that really helps. I'd also recommend hedging commodity costs. There are banks and services out there that allow you to do some commodities hedging. If you have a reliance on certain commodities, should definitely look at doing that. And then you really need to take a look at how your inventory and your source of goods for whatever products you may be producing is distributed. There, obviously, with COVID, we had a lot of disruption, whether you heard about what was going on in the ports or whether it's about even getting workers back in Korea to get to the plant to be able to be able to produce because of COVID. You need to really think about your supply chain and make sure that that's as effective as you need it to be. And so those are kind of my top 5 or 6 headline things to kind of look out for, and what you can do to kind of help provide some stability and some success for your business as we're in this environment. I will tell you, I don't think the recession is going to be that significant. I think it's going to be pretty mild. And especially given, if you think about what the federal government did in response to COVID, and really what they've done in response to every kind of weakness that they've seen, they've basically stepped in and filled the gap. I think that that's expected as we go forward. And so we'll see if kind of recessions really have the same kind of long downward strike that we saw for 2008, which I don't think that those excesses are going to be repeated. I'll go ahead and remind everyone, I think we had a few new folks come in. Please feel free to type any questions in the chat. I'd love to kind of hear what's on your mind and happy to answer those. I will just touch on some corporation. So I've kind of talked about consumer a lot. If you think about what's going on with corporate America, S&P is really very strong. I would say not just the pricing, but their earnings are really strong. Profit margins are at really above historical averages. They've got plenty of access to capital. They've got lots of cash on hand. And so I would think that most industries are really expanding with the reopening post-COVID. And I think that's all very positive for for that corporate America earnings stream and for really supporting what we look at on the credit side, right? So the companies that we make loans to. Well, the negatives, which I'm sure all of you are experiencing, is the tight labor market. It's really incredible how hard it is to hire someone, to find the right person, and to get someone without the wages that are rising so fast. I mean, even in the banking industry, I can't remember the last time before this year we raised the minimum wage for our tellers, but the banking industry moved the minimum wage to $15 an hour, then to $18 an hour, and some of them are even moved up to $21 an hour. And that's just indicative of that, and that happened over 6 months. I mean, that is a major increase, but really about retaining talent. And I would tell you another point into this recession or into this environment, retain good people. It's a whole lot easier to pay someone a little bit more now than to have to go find somebody else to replace them. So retain good talent and do your best to don't be afraid to, because you'll be, I think, sticker shocked if you had to go replace someone, especially at this, and then retrain. There are rising input costs too, and I do think that we're experiencing some lower productivity. And then the other thing that's negative is that credit spreads are widening, especially in public markets. You can see that the corporate credit spreads have really widened out. When you have smaller credit and you look at banks, banks are really slow. Admittedly, we're really slow to move those credit spreads. So back to locking in fixed rate debt, you better do it now because we will be raising credit spreads as well, much like the public markets have. It just hasn't fully taken effect yet. So think about that. And then on the small business side, I think there was a small business sentiment index that came out last week. It's falling pretty fast. Small businesses are feeling pretty constricted, and that the outlook actually was the worst outlook that they've ever had. It was at historical lows at a -61 reading, versus in 2012, when we were in the midst of the recession, it was a -36. So it's almost double what it was in the recession. So something is disconnected, especially in the small business space, about what the next year looks like. And so usually when you see those kind of differences in perception, there's something that can be taken advantage of it, whether it's probably not going to be as bad as everybody thinks, or some segment is feeling pretty good about things and others are not. But the small business optimism index was pretty eye-opening this week. Another good thing that's going on, I just got another question, and sorry, it was actually a little while ago. Business owners, how do you think the mass migration of people within the U.S. is driving some of the main economic headlines today? Inflation, higher real estate prices, job openings, et cetera. So I would tell you that, and I think you're talking about the mass migration from kind of north to south, the southeast specifically. It's having a very specific impact on regional real estate prices. If you look at the price appreciation in the Northeast versus the Southeast or even the Southwest, it's much higher in less traditionally populated areas. And Utah is experiencing the largest real estate price increase of the whole country. So it is very geographically specific, and it is driven by this migration that we're seeing. I do think also that inflation in general is less regionally specific, and that actually is happening across the board. So I would say the real estate side is more regional, but inflation is not. And I think the lack of job, or I should say lack of employees to fill the job openings, is kind of across the board as well. We've had a lot of conversation politically in this country about immigration. And immigration, when you're free with it, allows for prices to fall because you have people that come in and are willing to do a job for cheaper. And you have population increasing, which is something that the US has kind of been lagging on. And so one of the solutions to fix some of the inflation as well as the availability of workers is to allow some immigration. I think it can't all be solved with internal migration. That actually has to be solved with immigration, providing some additional resources internally. And the other question, business owners may consider using a home equity line of credit to pay for business expenses. What are the pros and cons of using home loan for business purposes before they make that decision? It's a great question. Home equity lines tend to be floating. So they tend to float off a prime. You need to be careful because rates are going up. So I would say if you can find a home equity line that is actually fixed, or a home equity loan that is fixed. So the difference between a line versus a loan, right? A line is available for revolving. A loan is something you take out and you pay back on a scheduled period. I would focus more today on loan than a line. I know you're probably taking out capital that you may not need immediately, but the cost to finance that is a known cost and that you can plan for. And I would tell you that if you can get, excuse me, and find a way to invest that money a little bit, you're probably better off if you find some floating rate investment when you get your fixed rate of debt. That way you can kind of have that to mature when you need it and when you need those resources. Trying to think of there's probably other implications in there about using your home for your business that I'm not as well versed to talk about as it relates to guarantees and other things that you may need to make for your business. But think through that as it relates to the cost of that debt and how that might change, because we are going to see a prime at a 650 in the not too distant future. It's a good question. Another positive in our economic environment right now is that banks are really positioned very well to support growth. Banks have very relatively higher capital levels. The margins are expanding at banks, so banks are going to be making more money because rates are up. In a zero rate environment like we've been at for many years, banks don't make a ton of money. But when rates go up and there's more spread, there's an ability for banks' margins to increase, and you'll see that. So the banks are stronger in their earnings stream. And then they've got a lot of liquidity. Loan to deposit ratios at banks were pre-COVID around 85%. Today they're 70%. So there's a lot of ability for banks to expand lending, which is also another reason why I think that inflation is going to last longer, because there's an ability for banks to help provide financing. The question is going to be, as rates rise, whether or not business owners and corporations are going to be willing to borrow at that cost, and if they can make a return on capital, it's going to be sufficient to overcome the cost of that borrowing. And I know I'm running up against 9:52 or 10:52 your time, so I want to be sure that I leave time for questions. Please remember to put those in the chat. Hope, I don't know if you have anything else that you wanted me to touch on, but I'd be happy to take the last few minutes to do that. I really appreciate everybody's time and attention.
Oh, we appreciate you. We can actually just open it up for general questions here. Tell, how long do you think that we're going to be in this mild recession of sorts? So I think that it really is going to depend on COVID. I mean, the reason we had negative GDP growth in the first quarter is because we had a spike in that, and I keep losing track of the variants. Was it Delta? It was January Delta. But I think depending on how those variants go, we may dip in and out of positive to negative GDP over the next 12 months to 15 months. And then I think the recipe for the future is, can the Fed get inflation under control so that we can get some positive growth, some real growth? We're going to have nominal positive growth. I'm more concerned about, can we get some inflation adjusted growth out of this? And we may not for a long time. And I think that's what everybody's still waiting to see. For our businesses that are here specifically, you've touched on the tight labor market. Just with retaining our staff and keeping it, are there other things that we can do to perhaps attract if we have vacancies? We found that rewording some of the language to benefits has been helpful in some scenarios. What are your initial thoughts on that and attracting? One of my close friends runs production for Shipt, which is a Target company that does grocery delivery, and they're a technology company, and that it's really difficult for them to hire, retain, and maintain talent.
I would say if you're looking for creative ways to hire talent, look to the technology industry because they've had to get really creative on attracting new and innovative talent. And it would be good to kind of take some of their best practices and put them to use. A lot of what they did pre-COVID was making the office environment with tons of goodies and opportunity. Well, as soon as COVID hit, none of that appealed to anybody because they weren't in the office anymore. It was no good. So they've had to really tact and change. If you have a friend in the technology industry space who does any kind of hiring, I would look to them for some good options.
I got, and this may be more of a loaded question. I'm not sure, but you had mentioned earlier that, based on the government's willingness to step in and essentially save, I use the word save, it's not probably the correct word, but save and fill that gap when you have a recession like this. And because of that, you believe it's still, it's going to be a mild recession and we won't ever get to where we were in 2006, 2007, 2008. Do you believe that at some point, because of the continued rising debt of the federal government, that becomes unsustainable?
That is a great question. I would say it's a long way off. And to your point about save, I would say the government would spend their way out of it, and then the Fed would guarantee their way out of it, right? So the Fed guarantees debt to make sure that things remain stable, and the Congress and fiscal side spend their way out of it. The U.S. is blessed with an awful lot of wealth. Higher taxes could solve a lot of spending. And that creates all kinds of disruption. It creates a competitive disadvantage, but we have the ability to do it. The willingness, I think, is the bigger challenge, is can we socially get behind something strong enough to allow the wealth transfer that would need to support that? Because it really is a wealth transfer that would need to support that. And that is the $1 million question. Will the country and what happens when you start to do that? Do you have this? What happens is people who with wealth leave if they're taxed too much. And the question is, where would they go? Is there an alternative for them that's more attractive? And I think right now I would say there isn't. And I would say that the U.S. is still the best place on earth to live. It's got its problems, and they definitely need to be addressed. But it's difficult to see the upper end of the economic spectrum leaving the U.S. in great droves, and yet they could pay for a lot of the necessary spending to support those things.
Are there any other questions, Javen?
Nope, I'll just tell him thank you. I appreciate it.
Yeah, absolutely. Well, again, we want to thank all of you all for being here with us today. We thank you for you coming on early in the central time zone for us to present this. Again, the chamber is paying attention to what's happening in the world around us and want to make sure that we're providing our members with timely information and accurate information that can help them with their business during this time. We didn't see COVID coming, so if we can prepare for this a little bit more, that's what we are here for. So thank you all so very much. This recording will be on our YouTube channel a little bit later. Again, Tell, if you have any closing remarks, we'll let you swing us out of here.
I appreciate it. Thank you. It's been a pleasure. Hope everyone has a wonderful end of the summer here. Enjoy the season.
All right, you guys, thank you all so very much. We'll see you again.
Bye.
Thank you, Tell. I appreciate it.